China has recently been criticized for pulling a page from the West's economic playbook, that is, Western financial institutions using loans to expand their influence over the world. China has particularly focused on infrastructural development in Africa, issuing loans to African countries in exchange for their critical assets as collateral.
Over the last decade, the world has been worried about the relationship between China and Africa. This is not from political or societal ties, but from the influx of money to the development of Africa from China. Today, only Eswatini has refused any form of loan from China, as the debt owed to China from the remaining African countries continues to grow. The world is also worried that the African nations are falling into a debt trap, with loans that will never be able to be paid off intended by China.
Concerns are growing over China's debt trap. Experts say that Beijing intentionally, excessively lends money to low-income, indebted states that cannot later repay Chinese debt. The borrowing state is thus forced to relinquish some of its strategic assets to decrease its debt burden towards China. Basically, a debt for equity swap. The countries are becoming ensnared in a debt trap that leaves them vulnerable to China's influence.
Since 1957, when newly independent countries like Ghana and Sudan joined the International Monetary Fund (IMF), Africa has become an integral part of the international lender. The IMF says one of its main goals is to provide diverse financial support to many of struggling economies in Africa, with a long-term goal of ending poverty.
Our biggest role to help Africa is to support Africa to grow. So growth is the best way to beat debt.
But over 5 decades later, African economies are wallowing in unsustainable debts, plunging them into cyclic economic crisis.
US President Joe Biden is in Angola as Washington seeks to counter China's growing influence on the African continent.
With just weeks left in his presidency, Joe Biden has finally made his first trip to sub-Saharan Africa as US president. The Biden administration is keen to showcase the US's commitment of $3 billion for the Lobito Corridor Railway project that connects inland mineral producers Zambia and the Democratic Republic of Congo to Angola's Atlantic port of Lobito. The rail link is aimed at making it easier to export critical minerals from Africa. He's set to attend a summit on infrastructure investment there on Wednesday with other African leaders. In a meeting with his Angolan counterparts this Tuesday, President Mr. Biden said that the US was all in on Africa to boost economic ties, even though it's his first and only trip to sub-Saharan Africa as US president.
You've heard me say it before, Mr. President. The United States is all in on Africa. We've already, my administration alone, has invested over $3 billion in Angola thus far. The future of the world is here in Africa and in Angola.
After colonization, the West gave much financial aid to African nations, but eventually stepped backwards. At the same time, Africa was tired of being the continent to be pitied with aid and wanted to be trading partners instead, which was an opportunity for China as it grew to be a superpower over time. First, both entities traded, but as time went on, China was able to flex its financial muscle to propose financial loans, which again over time grew to financial major infrastructure projects across the continent.
Now, the Chinese policy in Africa is often described as a debt trap. Experts say it is a part of a deliberate strategy to loan unmanageable sums to African countries, draw them into China's sphere of influence, and force unfair commitments upon them. A recent study says that Beijing is winning lion's share of construction projects in Africa. In the 1990s, about 8 out of 10 contracts to build infrastructure in Africa were won by the Western companies. By 2013, that is when Xi Jinping became the president, the Western firms were running 37% of African infrastructure projects versus 12% for Chinese companies. According to a report, the tables have now turned. That's what the report claims. The Chinese companies accounted for 31% of the African infrastructure contracts valued at $50 million or more in 2022. compared with 12% for Western firms.
China built the AU building, many dams and railway systems across the continent. China right now is even financing the new administration capital project in Egypt and aids nations in manufacturing goods on the African continent before exporting them to China. China has been Africa's biggest trading partner since 2009, and at this time, China holds about 21% of Africa's debt, spending over $160 billion on the continent. The relationship, however, is criticized, particularly by America, believing that China is taking advantage of poor leadership and corruption.
Amid China's coercive tactics, the EU and US are now trying to catch up. In June, the G7 leaders pledged to raise $600 billion in private and public funds over a span of 5 years in a bid to finance infrastructure in the developing countries.
Recently, China's loans to Africa have been coined as debt trap policy, a concept in which China is taking advantage of Africa's willingness to borrow large sums of money, knowing they will not be able to pay back in full, with the intention of seizing assets, therefore having more control of the continent. They also think China is looking to colonize Africa, gain strategic support on the world stage if the time ever comes, make even more money from loans, or gain access to strategic assets. Africa owes about $8 billion, with most coming from Angola. And with the default happening, China will definitely be the biggest loser here. China will have to work with each African country in terms of how to deal with the default. There are three major options. The first will be to forgive the loan completely, which is a complete loss. The second will be to restructure the loan by extending the lifetime of the payment, which could generate more interest or just purely reduce the monthly payments. Then there is the option of suspending repayments for an allotted amount of time, which could be a reduction in the total loan or an increase in monthly payments.
Ethiopia, Ghana and Zambia have all defaulted on their debt in the past few years, and the World Bank estimates that a further 15 African countries are currently at risk of default. These include some of the biggest economies in Africa, like Egypt, which has just negotiated a $3 billion bailout loan with the IMF. Kenya, which has had a debt-to-GDP ratio approaching 70% and is currently in talks with both the African Development Bank and the World Bank for budgetary support. And Tunisia, which has a debt-to-GDP ratio around 90%, but has refused IMF support on the grounds that the austerity-like reforms required to unlock IMF support would stoke political unrest.
But what about seizure of assets? A concern of the world is that China could use the default on loans from certain countries to seize land. An example is the Entebbe airport in Uganda. In 2015, it was reported that China was going to seize the airport as Uganda defaulted on its $200 million loan from China. However, China responded by stating they have never seized any assets as a form of collateral. Looking into those words, China has not said it can never seize an asset.
A lot of African debt is due in the next few years, and because Africa's lenders, including both the West and China, are bickering amongst themselves about who gets what from the subsequent restructurings. African countries significantly increased their debt burdens in the 2010s, when interest rates were low and money was cheap. And national debt as a percentage of GDP across the continent rose from about 30% in 2010 to more like 55% today. While only about 40% of that debt was borrowed on the international markets, that's still quite a bit, and Africa has really struggled with the recent rise in interest rates, not least because international investors basically stopped lending to Africa last year. This meant that many African countries were unable to roll over their debt, which is when you pay off your loans with more borrowing.
For the country that cannot pay the loan, it would have to be creative in how it builds capital to repay the Chinese lenders. Either it would have to borrow money from the IMF, look further into debt forgiveness, or it may have to turn to itself and depend on its private sector or even taxes to repay the loans. In the long term, this affects the African country's ability to borrow money, as it will have a history of not fulfilling its repayment obligation. The nation will become a high-risk lender henceforth.
Over the period from 1952 to 2023, the IMF made a total of 1,529 loan commitments, of which around 40%, that is 608, were to African countries. Over the same period, in volume terms, Africa accessed less than 10% of the IMF's total commitments. African countries have made it a habit to turn regularly to the IMF for resources when hit by global and internal shocks. 48 African countries collectively owe the IMF $42.2 billion. That is nearly one-third of the IMF's total outstanding credit, making the African continent a significant borrower of the IMF.
We work very closely with African countries to be a source of liquidity and reserves for them.
But juicy as that may sound, IMF financial support have always come with tighter conditions. Terms like austerity, privatization, liberalization, deregulation, and currency devaluation are often associated with loans from the IMF. Some analysts say these policies and conditions attached with the IMF loans alongside bad economic management by African countries have resulted in making the situation worse than better.
A couple of factors have conspired to make things particularly difficult for Africa this time round. First, many low-income African economies rely heavily on exporting commodities like oil, metals, or minerals. But unfortunately, weak global demand means commodity prices are low at the moment. Second, in some part thanks to climate change, harvests in certain African countries have been poor recently, which has increased food prices and stoked political instability. Third, weak tax revenues have caused Western countries to cut their aid budgets, and China, previously Africa's biggest creditor, has also significantly cut back on development aid and investment. But one of the underreported issues here is the fact that Africa's creditors can no longer agree on what happens in the event of a default. In the past, most sovereign debt was issued by Western countries and big institutions like the World Bank. So when a country defaulted, they would come together via a forum called the Paris Club and agree on who got what, i.e. a restructuring. Unfortunately for many African countries, sovereign lending today is a lot more complicated. Countries now also borrow off a whole load of other creditors, including Western financials, China, and its complicated web of state-owned enterprises. And more recently, Gulf states like the UAE and Saudi Arabia, who've stepped in to fill the gap left by post-pandemic decline in Chinese foreign investment. While this means more cash for African countries, it also means that restructuring is really difficult, because China and the other new creditors aren't in the Paris Club, and they don't get on well enough to quickly come to an agreement. Zambia is a good case in point here. Zambia defaulted way back in November 2020, but China and the Western creditors, including a whole load of private financials, are still yet to agree on a comprehensive restructuring plan, in part because China wants sovereign creditors like itself to get more money than private Western companies. Unfortunately, prolonged restructurings are generally bad news for the global economy, because they basically mean that countries like Zambia have to just sit it out on the sidelines until it's done.